In late 20s of last century, the world was a different place. The average price of a house in the United States was about $6,000, a modest sum by today's standards. But here's something fascinating. If you had 10 kilograms of gold, worth around $7,000 at the time, you could have walked into a neighborhood and bought yourself a home with a little extra left over. Fast forward nearly a century to 2024, and the landscape of real estate has dramatically transformed. Now, the average house price has soared to approximately $500,000. But guess what? 10 kilograms of gold today, valued at over $700,000, would still be enough to buy that same house. How is it possible that while the price of a house in dollars has exploded, in terms of gold, it has remained relatively steady? This phenomenon boils down to the nature of gold and fiat currency. Gold is finite. There's a limited amount that can be mined, and its supply increases at a slow, predictable rate. Contrast this with fiat currency, money that governments can print and banks can create with a stroke of a pen. Over the past century, especially in the last 50 years, many developed economies have engaged in a strategy of lowering interest rates and expanding credit to fuel growth. This strategy, while effective in boosting economic activity, has also led to significant increases in asset prices, particularly real estate. Let's take a closer look at the numbers. In the 1950s, the average house in the U.S. cost around $8,000. By the 1970s, this had risen to about $23,000. In the 1990s, the average home price had climbed to around $120,000. And today, we're looking at figures that are pushing $500,000. Yet, despite this dramatic increase in dollar terms, the price of gold has adjusted in tandem, keeping the gold-to-house price ratio surprisingly stable. So, why does gold retain its value while the dollar fluctuates? It's because fiat currencies are inherently elastic. Governments and central banks can print more money, especially in times of economic stress. This increases the money supply, which can lead to inflation, devaluing each dollar in circulation. Real estate prices, which are closely tied to the availability of credit and interest rates, rise as more money chases the same number of houses. But when we compare house prices to gold, a stable, finite resource, the inflationary effect of fiat money becomes clear. Gold doesn't just maintain its value, it acts as a reliable yardstick for measuring the true value of assets over time. Take the housing market crash of 2008 as an example. During the bubble, house prices skyrocketed, fueled by easy credit and low interest rates. But when the bubble burst, many homeowners found themselves with properties worth less than their mortgages. If you had measured house prices in gold during that period, the bubble would have been less pronounced, giving a clearer picture of the market's true health. This story isn't just about gold and houses. It's about understanding the broader economic forces at play. An elastic fiat money system allows for flexibility in managing economies, but it also carries risks, particularly the risk of inflation and asset bubbles. Gold, on the other hand, offers stability and a long-term perspective that can help you navigate these turbulent waters. At the end of the day, understanding the relationship between gold and real estate provides invaluable insights into the nature of wealth and value. Just as gold has maintained its purchasing power over the decades, you too can secure your financial future by being informed and making wise decisions in the housing market. The decision between investing in gold or real estate ultimately depends on your financial goals and risk tolerance. Gold has proven itself as a reliable store of value, maintaining its purchasing power over the long term, particularly during times of economic uncertainty. It offers liquidity and a hedge against inflation, making it an attractive option for those looking to preserve wealth. On the other hand, real estate has the potential to generate consistent cash flow through rental income and can appreciate significantly over time, especially in growing markets. It also provides a tangible asset that can be leveraged for further investments. For those seeking stability and a hedge against market volatility, gold remains a solid choice. However, if you're looking to build wealth and are willing to navigate the ups and downs of the market, real estate can offer substantial returns. Diversifying your portfolio to include both could be the best strategy, balancing the security of gold with the growth potential of real estate.